And welcome to Capital Market Live on Channels Television. I'm Will Ibang. First things first, let's check in on the markets and see how your stocks performed for the week. Let's start off with European markets, where stocks closed higher on Friday as the US debt ceiling talks boosted investor sentiment. The FTSE 100 inched up 0.19%, while France's CAC 40 rose 0.61%. Now, the German DAX climbed by 0.69%. Meanwhile, the German stocks extended previous day's gains, with the DAX index climbing 0.8% to an all-time high of 16,275.38 points. Traders will be keeping an eye on the Group of 7 summit in Hiroshima, which started on Friday, where world leaders are expected to discuss international trade and security. Now, in Asia markets, stocks were largely rose as 2 of the 3 Wall Street's major indexes hit record highs on Thursday night, and this was based on hopes that a deal could be struck on the U.S. debt ceiling by next week. Greater China markets, however, bucked the trend as Hong Kong's Hang Seng Index fell 1.4%, while the Shanghai Composite slid 0.42% in mainland China to end at 3,283.54 points. Japan stocks marked its best week since October as the Nikkei 225 rose 0.77% and ended at 30,808 points, maintaining the highest level since 1990. Meanwhile, leaders from the Group of 7 are gathered in Hiroshima, as I mentioned earlier, Japan, for the G7 summit that kicked off on Friday. Now, stocks fell on Friday in the U.S. as GOP negotiators halted ongoing debt ceiling negotiations, stoking doubt of a deal being reached soon. However, the S&P 500 notched its best week since March. The Dow Jones Industrial Average dropped 109.28 points to 33,426.63 points. The S&P 500 slipped 0.14%. The Nasdaq Composite shed 0.24% to 12,657 points. However, all 3 major averages capped the week with gains. Now, back home in the domestic equities market, losses recorded in the shares of top telecommunications player Airtel Africa on Thursday triggered the market to close lower, causing the local buzz to suffer its second consecutive weekly loss. Specifically, we look at the all-share index declining by 0.05% to close at 52,107.55 points. And now the month-to-date loss has moderated to negative territory to 0.4%, while the year-to-date return settled at just about 1.8%. Now, activity levels were also weak. We saw traded in the week volume and value declining by 16.2% and 8.4% week on week. Now, sectoral performance was mixed. We saw insurance, banking, consumer goods indexes posting gains, while the oil and gas and industrial goods indexes declined. FTN cocoa processors emerged top gainer for the week as the stock price appreciated by 37.5%, while CWG led the decliners. Meanwhile, Fidelity Bank top trades by volume this week, followed by Access Holdings. Now, we're going to be spotlighting, zooming in on the performance of the oil and gas sector on the NGX year to date. Now, the index, although it declined yesterday's trading session, however, we've seen a relatively stable index performance in positive territory despite the volatility in the sector, in the global space, in the global oil markets, especially with the Russian-Ukraine war and restrictions, COVID restrictions we saw in China. Now, if you look at the oil and gas index, it hit a 52-week high year to date of 569.84 points. Now, it also had a 52-week low of 441.45 points. Volume transacted year to date, we've seen 145.61 million, transacted in that sector. That's a huge number. That's year to date. We're expecting what we'll see going forward. Now, up in percentage points, we have 18.05%. That's a good number. Why we're doing this is because it's barely 2 days before the commissioning of the much-awaited multi-billion-dollar Dangote Refinery, and there's a lot of buzz, expectations from Nigerians and Africans as a whole. And we're going to be talking to Dr. Ayodele Oni, partner and chair of the Energy Practice Group at Bloomfield Law Practice. He joins me this evening to unpack what this means for the economy and not forgetting also the capital markets. Good evening, Dr. Oni. It's good to have you on the program.
Thank you very much for having me.
Now, Dr. Oni, it's quite exciting, Dangote Refinery coming on board. This is something new for Nigeria, and different stakeholders from various sectors of the economy. We've seen industry players from the NECA, as the Nigeria Employers Consultative Association, and the Manufacturing Association of Nigeria, expressing the view that this could be a renaissance for the industry, for the industrial sector, in view that we're going to be seeing a 650,000 barrels per day capacity refinery coming on board. And this, they said, the country urgently needs. What are your thoughts about this, Dr. Oni? Do you think it's a renaissance?
I think that's very correct. I think that's very correct. The challenge we've always had is not the lack of base resources, petroleum, crude oil, natural gas, but refining, converting same to usable products, to white products, So that's affected adversely our balance of trade, balance of payment, even forex. If you look at the numbers, you see that Nigeria spends somewhere around 70-71% on servicing debt and paying subsidy, and over 32% for subsidy payment. So it's a challenge when you continue to import finished products. So I'll give you a small analysis. Do a small analysis. Imagine you make $1 billion from selling crude, and you now have to buy finished products for $1.2 billion. You're on a deficit of $200 million. So I think it's going to be positive. I also think issues around employment, and there's a multiplier effect. It's not just a refinery. It's going to create jobs around products, plastics, those who middlemen, wholesalers, even transportation. So I think it's a big deal, actually. It's a really big deal for our economy, balance of trade, balance of payment, and even forex. Because the more pressure you have on the naira, the weaker it becomes. So if that pressure reduces because we need to import less, remember, when you import finished products, apart from the cost, there's haulage, international haulage, there's international insurance premiums you need to pay. There is STS, ship-to-ship transfer costs. There are additional costs. I think about 7 additional costs. So imagine taking all of this off, and we become self-sufficient in producing and have sufficient to even then export. Some of that will then be exported. So it would improve our economy overall. It should improve our economy overall. So I think it's a really good thing.
You've said a lot of things, Dr. Odi, and some things we're looking forward to hear, something we really want to know. But what we would want to know, especially in the mind of Nigerians, I'm very sure, is you mentioned the cost that, it would take out, the lots of costs, the freight, the shipping costs. But should we expect any change in the price of petroleum products anytime soon, from what you've said? Would we see any change, significant change?
Okay, interesting question. I look at it from 2 perspectives. If government does remove subsidy, it definitely will go up, with or without the Dangote Refinery. Now, the difference is that it wouldn't go up as much as it would have if there was no refinery. Remember that there's a cost for this refinery. There was a cost for putting this together. The capex, some of it in USD, very little in Naira. There's also the operating cost. So it's not that the prices will reduce substantially. It's just that it won't be as bad as it would have been if we didn't have a refinery. If government took out subsidy, if you check Africa, around West Africa, you see it's between $1.10 to about $1.20. Convert that to Naira, especially for countries that don't produce. So add a premium that we produce, discount that price. It will still be somewhere around 600, maybe between 400 and 600 if you take away subsidy. That's the truth. It would have been more expensive without the refinery. So the refinery takes out about the 27% handling cost at the port and those other additional costs I've mentioned. So overall, it's a good thing for us. But if government doesn't take out subsidy, it means government would spend less on subsidy, but the prices will remain what they are, or a little difference. The major difference is whether government takes out subsidy or not. If government removes subsidy, they would have to pay the actual price. Of course, it has to be a profitable venture. Remember, it took loans and there were cost overruns. Remember, it's going to pay salaries. Remember, it's going to pay back loans. So you don't expect that it will be free or necessarily very cheap. But there's value for refining locally. So you take out a number of costs you would have had if you had to import petroleum products. So I wouldn't say it will be cheap, but it will be better than what it would have been if we were importing, especially if government takes out subsidy.
Speaking of government policies, now given the scale and the quantity of the daily output that's expected from the Dangote Refinery, we're talking 650,000 barrels per day. You mentioned the subsidy, possible subsidy removal, but will this shape regulation and other policies in the downstream sector? We will see that policy shift that has been clamored for in the downstream sector of the oil and gas industry.
Oh, naturally it will. Naturally it will. If you look at the Petroleum Industry Act, quite a copious provisions. I think Section 205, a number of sections around market-driven pricing and all of that. It's going to shift. You know, subsidy, I say that keeping subsidy is fiscal rascality. So with time, my challenge is that for you to remove subsidy, you should have three important elements. We should produce locally, we should have other means of transportation, and we should improve the power sector, particularly public power supply. Then people will use less petroleum products, particularly fuel. Then if you use less, it means that even though subsidy has been removed, you will be using less quantity. And at the end of the day, you wouldn't be spending much more than you were previously. So I think subsidy needs to go. Subsidy will go. This is one of the elements that need to be in place. Even the organized labor unions have said that once we can refine locally, that's one of the things they want to see for them not to create challenges around subsidy removal. So I think it's going to impact government policy. Also because no businessman wants to do business without making profit. It's not a social good, and it's not running a charity. So you expect that you do it profitably. He needs to pay back loans running to tens of billions of dollars. He needs to be able to pay staff and pay them reasonably well. So I think that it would shift policy. It may not immediately have a huge lead to a huge policy shift, but we begin to see policy shift. And I understand that the incoming administration is keen on removing subsidy, and I think it's a good thing to do. We just need to ensure that those things that need to be in place are in place, so that maybe it's not removed wholesale, but removed in piecemeal, such that at the end of the day, people don't feel the impact as much as they think they will. So I think it should lead to a shift in policy.
Okay, so talk about other benefits here. I want you to expatiate more so people will see actually what to expect, because a lot of Nigerians probably think that when it comes on board, fuel is going to be cheap and they don't have to, because they say it's produced in the country. But talk about you mentioned the cost. So is Dangote going to be buying it in dollar? Is it going to be buying it in naira? Because we need to know what to expect. And apart from taking off the queues from the petrol stations, what other benefits do you think this will bring to Nigerians? How would it alleviate some of the pain they're already feeling right now in terms of scarcity of petrol, the long queues, and unavailable of petroleum products in short?
Okay, so it'll do quite a bit. First is that we need to disabuse our minds. It's not necessarily going to be cheap, because he's going to be buying crude. Remember, what he's doing is refining. He's going to be buying crude and then refining. The crude he buys comes at a cost. I understand the NNPC is going to make available about 300,000 barrels per day. You understand? He needs to buy, and he would add a margin to make money, because he needs to pay back debts. He has capex and opex to deal with. Now that's that. In terms of the advantages, I look at where you are seated, and I see that about 3/4 of what you have there is produced from petroleum. So from your computers to plastics to headphones to chairs to almost everything. So it would go to improving value addition. The problem is always been value addition. Value addition would improve. We will see more jobs. We will see industries around plastic. We will see middlemen who want to deal with logistics. We will see several things, but not necessarily a substantial change in pricing, especially when government removes subsidy. But it will be better than, that's what I say, it will be better. So you see improvement around fertilizer, even agriculture, because rather than import these things, you'd have them produced locally. It would, even in terms of logistics, moving them around and reaching final consumers. Remember issues around even scarcity. Part of the challenges with scarcity was the international shipping, issues you had with bringing it in, issues with Russia. If you have it all localized, then the vagaries and the challenges internationally would have very little to no impact on our availability, and it will improve. You know, when you speak to security of speak to energy security, you look at two broad issues: security of energy demand and security of energy supply. We do have a challenge with security of energy supply. That's why you see the fuel queues. That's why we don't have electricity all of the time. So with production and refining done locally, it should impact positively and substantially security of energy supply, particularly around petroleum products. And the queues we see every December should disappear. I think that's one of the things we will see with what you have. And it will take up, if you look at the Nigerian Bureau of Statistics, if you see their statistics, more often than not, you shake your head in disbelief and you feel sad as a Nigerian. I think some of those indices would improve. You understand? The CPI would have gone haywire with the removal of subsidy if we were not producing locally. So I don't think it would go as bad as people think, the consumer price index, inflation and all of those. Because international crude prices, refining prices, and cost of bringing them into Nigeria play a substantial role in that. And we also think the Naira should stabilize much more than it has in the last 2-3 years. It's been very bad in the last 2-3 years.
Okay, Dr. Oni.
Those are the multiplier effects of...
Okay, Dr. Oni, we're going to take a break now. We'll take a moment. Just hold your thoughts. We're going to take a moment. When we come back, Capital Market continues. Welcome back. If you've just joined us, I've been discussing the upcoming launch of the Dangote Refinery. Dr. Ayodele Oni, partner, Energy Practice Group at Bloomfield Law Practice, and he's been sharing with us the economic impact this would have in the country. Now, we're going to be continuing this. Doctor, you're still with me on this conversation. Given the scale, we've talked about the imports that this will have on job creation, and you talked about some of the benefits. Well, we've talked about some of the investment possibilities this could bring for the country. Well, for Dangote Refinery and also for other oil and gas companies that are in the country.
Okay, so the fun thing is that we already have a number of modular refineries. Now, you'd ask, why haven't these modular refineries solved the PMS problem in particular? Now, there's an equipment that many refineries generally have. Larger refineries that the small refineries or modular don't have. I think it's the hydrocatalytic, some equipment for you to be able to refine PMS. If modular refineries buy or add that to their refineries, in the lifetime of that refinery, it may not be profitable. So it would only work for larger refineries. So that's an advantage. Now, the Dangote Refinery will be able to deal with PMS, whilst these other guys who are already in place, a number of them, 2 or 3 of them are currently operational. One in Obele, I think there's 1 or 2 others that are currently functional. You'd give them the opportunity to do more in terms of export. You know, that's an advantage they would have. Now, in terms of those other people who can invest, and I believe with time, they would float a number of shares in the stock market for people to be able to invest, at least for the next 20, 30 years before energy transition takes the front seat. I think for now, everyone still needs hydrocarbons. See what's happened in Europe with the war. Everyone went back. Some went back to coal. Some went back to nuclear. You know, everyone wanted petroleum products once the war started. So that's taking back the debate around energy transition. I think more is going to be done around refining. I think there'd be industries that rely on refined products, and it should push down a bit cost of production, and that's important. You see a number of factories set up in Nigeria. You hear people talk about Dunlop coming at one point. I don't want to keep mentioning companies. A number of tire companies, dye companies leave the country. But as you have refining that can help push productive activities, then you'd have more businesses set up. You have more businesses stay. And those vagaries that normally impact adversely doing business in Nigeria because we rely on importation will go down, And you remember that challenge around being able to source Forex. Part of the reasons you've had that challenge is because a lot of Forex needs to be used to bring in finished products. So we'll be able to channel that into more productive activities. Farmers would have fertilizers readily available. You would have those other products you see from crude, from your premium motor spirit to your KP to your aviation fuel to propylene to everything else you require. You understand, to enrich doing business, and you then begin to see businesses that tee off each of these products. You begin to see new retailing. You begin to see more creative ideas around running businesses that currently exist. Even for real estate, I mean, there are issues around situating or living very close to the refinery. But because there will be workers, several workers going to that refinery, you would see that accommodation around the around Lekki, Aja will there'll be more value in building property. There'll be new schools coming up for staff. There will be new modes of transport being considered. And remember also that there'll be issues around shipping, more vessels coming into the country. All of those will be positive for us. It will improve our own balance of trade and balance of payment, particularly for those products that will be made in excess and then will be exported. And once this takes off, other people will want to invest. You just need an anchor person to kickstart serious investment in those areas, and you find other people coming to invest. So I think it's going to be, the multiplier effect is going to be quite substantial. I'm not saying it's going to be in the immediate, but with time, you begin to see people come up with creative ideas to tee off what's currently being done through that refining. And remember that even the NNPC is looking to kickstart the Port Harcourt, Warri, Kaduna in particular. I understand Port Harcourt should be ready, whether Q4 this year and sometime last year, Warri and Kaduna. So there will even be competition locally, and that can even drive down the price. If you have a glut. So those are the positives I see beyond just the refinery itself. Those businesses, from real estate to wholesalers to create even information technology, guys will begin to find solutions around their haulage problems, find solutions around theft, movement of trucking, virtual pipeline arrangement, all of those. You see people, even the service sector, you begin to see service providers becoming more creative across that value chain, across businesses set up connected to the refinery.
Dr. Ayodele, that's a whole lot to expect, and we do hope that in terms of the trucking and haulage system, there'll be more of a systematic approach to ensure that the infrastructure that is needed to transport these petroleum products are put in place to make sure that we get the full advantage of Dangote Refinery coming on board. It's barely Monday is the day. Maybe you're going to be there for the lunch, I don't know, but we're going to be watching it here on Channels Television and keeping everyone abreast. Thank you so much, Dr. Ayodele, partner and chair of the Energy Practice Group at Bloomfield Law Practice. Many thanks for your time this evening.
Thank you very much for having me. Enjoy the rest of your evening.
And now, before we go, the Nigerian Bar Association section on business law, Nigerian Exchange Limited and the Institute of Directors have held the maiden corporate governance colloquium in Lagos. The event themed diversity and inclusion, adopting a multi-stakeholder approach in the promotion of good governance, tackled issues around building a gender balance in the search for corporate governance. And that's what we'll be looking for in the capital market, more women, more equity in that space and bringing women on board. And we're hoping to see that soon. We're wishing Dangote good luck with his launch. And the president is coming to commission it on Monday. We'll be giving you live updates on Channels Television. Do stay tuned. And that's it on Capital Markets. Do join us same time next week. Don't forget you can watch this again on our Channels Television page on YouTube. Also follow us on our other social media platforms to get updates. I'm Will Ibong. It's bye for now.